finally here. The great, big December Fed policy announcement. As we get closer and closer to the end of the year, it looks like the markets are positioned to bookend what has been a blistering year and a half obsession with where the Fed is going to take interest rates after in mid-2021, they concluded that, in fact, inflation was not just going to magically go away by itself, and they would need to actually do something about it. And since July, the last time that they actually raised interest rates, the speculation has been rife about when, in fact, the end of the cycle will arrive and the cuts will begin. We may be at that point now. Welcome. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And we are going to go through how we got here, what the impact has been on markets, and how the Fed might influence what comes next now that it looks like we might be looking at the exclamation point, bookending the Fed's year and a half ordeal here. So first, did we get anything new from the CPI data, the inflation report, to shape these expectations just today? Of course, it has been an absolutely packed macro week, and so we would, on a week like this, have a critically important inflation report directly in front of what the Fed is about to do. Thankfully, there was nothing to look at here of substance. If we take a look at what actually came out, inflation at 4% at the core, that's excluding food and energy, as expected. Headline a little bit lower, down from 3.2 to 3.1%, also exactly as expected. So this CPI report right on the nose with what the markets thought was coming, and so doesn't really have much of an influence on shaping expectations one way or another. We can see here, as a matter of fact, that services excluding food and energy, that big gray area on the bottom, that still remains the main source of the Fed's concern. And if we look at how it moved over the course of this month, we can see all of the contribution to disinflation at the headline came from a slight pullback and a pullback of almost equivalent size in food and energy. The actual underlying trend in inflation, unmoved. Services, flat. Overall core, flat. Goods, just barely a touch softer. And so we end up with a situation where this report really gets filed under irrelevant for the Fed's calculus, at least at this point. What is that calculus? Well, if we look at expectations, we can see the market at this point sees no reasonable chance of further tightening, with the next move in policy being rate cuts. So we can see here the likelihood of another hike at this meeting, 1.2%. So clearly the market does not see it as at all credible that there is a change in rates this time. January is a similar story, 4%. We can already see by January that the bias has turned to easing. But nobody is, with any kind of seriousness, expecting January to be when that occurs. The likelihood of a cut increases to about 40% come March, but it's May where that cut is fully baked in. So come May, the markets see the first 25 basis point or quarter percentage point reduction in the market. There it is, down 2.5 basis points, 0.25%. Now, as we look through what is on the menu for the rest of the year, we see the second hike already in the market by July, the third by September, the fourth by December, with about a 36% chance for a fifth, which would be a cumulative 1.25% in cuts. So if we look at where we are currently, the rate is 5.3. We're expected to come down to 4.2, which is just a touch over 1%. Not quite enough yet to say that it's going to be 1.25, so 5 cuts, but 4 are already in, and there is some chance for a little bit more. How did we get here? Let's quickly review. The Fed comes in September, which is the last time that they updated their set of economic forecasts, on the 20th of that month, and says, right, we think we're going to need rates to be about 50 basis points higher in 2024 than we told you in June, which is the earlier time that they updated these forecasts. And so the market says, right, okay, so you're looking for cuts, that much is there, but you think that you're going to need 50 basis points higher rates, so you're looking for fewer cuts in 2024 by September than you thought were going to be needed in June. So the message for markets here, rates are going to be higher, and they're going to be higher for longer. But of course, how much longer is an open question. And we immediately see that uncertainty build into the market. These yellow bars here are the term premium in the 10-year yield. That's just a measure of the additional risk that investors are demanding for lending over a longer period of time, because there is uncertainty about where rates go over a longer period of time in this environment. The Fed signals higher for longer. Okay, higher is understood. Nobody seems to have a good reading on what longer means at this point. So greater uncertainty enters the market. The 10-year yield goes up to reflect this additional demand for a premium on longer-term lending for higher rates, even as the more policy-sensitive front end, the 2-year, stays put, signaling no further hikes. Then come November, the Fed says, right, okay, so the extra tightening that you've done here, that's already done the job for us. We don't need any actual additional rate hikes. We've just talked you into doing them for us. As it happens, this run-up right here, as you can see, lands us right about here, which is that very 50 basis points. This is 40 basis points. This is 60. 50 is right here, which is almost exactly the size of this adjustment. So here the market goes, oh, good. You're done. Interest rates come back in, uncertainty fades, and rate cuts begin to enter the outlook. So yields begin to compress lower. Not surprisingly, you can see very clearly in the implied policy path a dovish shift since that November FOMC meeting. Here is where the 3-year path was on the day of that meeting. We can clearly see it's shifted lower. It's normalized a little bit off the lows we saw a week ago. So it was a little bit more dovish. It has since corrected slightly, but the overall direction here, November 1 through now, is very clearly to a more dovish setting. So whereas then we saw the Fed holding rates basically unchanged for 6 months and then having a shallower easing cycle, now we see the easing has moved forward by about 3 months. So we're getting cuts sooner, and they're taking us deeper and giving us rates that are lower. How have markets responded? in the gray bars here, you see the number of rate cuts expected for next year. That's the spread between what Fed funds futures are anticipating for this meeting, which is no change at all, as we just saw, and where rates are by the end of next year. So if there's no change here, then what this is going to tell us is how much rates will decline next year between standstill this time to wherever we end up in 12 months. Notice from mid-year, the amount of rate cuts expected is decreasing. Stocks don't like this. They decline. As you get this dovish turn begin at the beginning of November, though, more rate cuts enter the outlook. That's this dovish shift right here. So more of them come in. Now you're looking, as we were saying, at the extreme of the adjustment about a week and a half ago, as much as 1.5% in cuts, and we've now moderated to about 1.25%, a little bit less, which is, again, exactly what we are seeing here. A change of 1 with a 36% change of 1.25%. So, as we see this, stocks surge, essentially celebrating that the headwind to growth that is continuous Fed rate hikes is ending. And the way forward from here will be cheaper money, not more expensive money. That, of course, is good news for any form of economic activity, because what it means is that financing virtually anything at all will be cheaper in the future than currently. And of course, that's financing for consumption, it's financing for investment, it's financing for much of anything, which is good news for corporate earnings, because it of course means consumers are better able to finance the very activity that those earnings come from. It's good news for investors, because it means that lending becomes cheaper to get the capital needed to make bets on assets. So markets, not surprisingly, celebrate as rate cuts build out. It's a similar story in the US dollar. As you get fewer rate cuts here, the dollar's yield advantage improves, and so the dollar goes up. As more cuts enter in, the dollar comes down. Very straightforward. Now, the next step here, of course, is with the Fed. As the Fed looks at this, then the question becomes, okay, well, the market had this large adjustment in November that the Fed ostensibly was the architect of, with its back and forth language saying in September, we need more tightening, then saying in November, good job, now we don't because you've already taken us at our word and done it. So do you now endorse what the markets have done, or do you push back? Well, if you're the Fed, your bottom line is your dual mandate. You are looking to get a return to price stability, which you've defined as an inflation rate on average around 2%. You've also arrived at a juncture where all of your tightening has finally started to cool the labor market. And so the second part of your mandate, maximum employment in the context of price stability, might now start to take more of your attention, because all of the tightening you've done is now poised to nudge the unemployment rate higher, finally. So as you look at what's happened in November, the thing that captures your perspective is that as you've had this dovish adjustment in rates, And what we've done here is just simply looked at what are rates expected to be 12 months forward from any given day. You can see over the course of November here, they top and then start to move lower. So there's a peak somewhere around the second half of October where the 12-month Fed outlook reaches a high at 5.2%. And we can see now, over the course of about 4 to 6 weeks, it's come off, shock of shocks, by just about 1.25%, but a little bit less because, again, that fifth cut is not all the way baked in. So it's a little bit more than 1%, but not quite 1.25%. Needless to say, there's symmetry around all of this. The key bit for the Fed is, as this has been going on, inflation expectations reached a peak and have come down. In the orange is the one-year inflation expectation from the swaps market. It's come down from 2.7 to 2%. And in the yellow is the two-year U.S. Treasury break-even rate. That's the inflation expectation from the bond market, the difference between nominal and real rates. There it's come down from around 2.2, 2.3% once you choose your way of rounding, also down to 2%. So as far as the markets are concerned, over the course of a year or two, you've arrived at target. But the really critical thing here seems to be that inflation expectations are falling as interest rate expectations are falling, which means that the market has very clearly signaled to us as investors and traders and to the Fed as officials that even though rates are seen lower, inflation will continue to decline, which essentially means the market now sees rate cuts as appropriate. It now says you can cut rates and inflation won't come back up because of the tightening that's already in the pipeline and the weakness that the tightening you've already done has caused in the economy. And indeed, looking at global S&P Global US PMI numbers, which are a more timely approximation of where GDP is going, what we see is very clearly slowing economic activity all through this whole ordeal. The Fed begins to talk about tightening in June of 2021. Not surprisingly, growth is at its peak just the month before and starts to reflect oncoming tightening going forward. You see here, and again, this is in the logic of PMIs, so 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So what you're seeing here is the manufacturing and the service sectors, manufacturing in red, services in orange, growing at an ever slower rate. That, of course, is going to pull the composite of the two lower in tandem. And you can see the composite mostly is tracking services because the U.S. economy is about 3/4 services, with a tiny bit in the ag share and the rest in manufacturing. So call it about 70% services, 20% manufacturing, 10% agriculture to kind of put big round numbers around it. So as all of this comes down, you then see a bit of a pop at the start of this year. The economy is in shrinking mode, that is sub 50. Come the tail end of last year, there's a bit of a pop in services. It crests by May, And where we are now is effectively standstill. We're going to get PMI numbers for December coming out just on Friday this week, and the expectation is barely any growth in services, 50.7, contraction in manufacturing, 49.5, which gives us economic growth at basically standstill. 50.5 is almost indistinguishable between growth and none at all. Almost full stasis. So, not surprising then that what you see here is inflation expectations falling just as the rates outlook is correcting lower. The collective message here is the economy is weak enough that inflation will continue to fall without more hikes. You can begin cutting. And indeed, those cuts won't bring inflation expectations up. Those cuts are actually needed now. So, from the Fed's perspective, this is about as good as they're going to have it. So the object with this policy meeting will be not to upset the apple cart. Now, given November's dovish shift, this is going to be a challenging sort of thing. Because if you don't endorse what the markets did in November, if there is no dovish signaling, if there's no admission that rate cuts are on the menu now of any kind, well, then what you've told the markets is everything they did in November was wrong. And the response might be markets scramble to bid up yields, bid up the dollar, because then they reckon, well, the Fed doesn't think what we did is right. They don't intend to cut with the kind of vigor we're anticipating. Maybe they might even still be open to the possibility of a hike if we take them at face value. Let's readjust. Now, if you consider what kind of weakness in the economy that the Fed is looking at here, that would not be the outcome they would want, because a more expensive dollar and higher yields would amount to tightening of financial conditions. It would be a rate hike by any other name. Effectively, it would be the same. It would make credit and the borrowing of cash more expensive. That is not the environment, growth-wise, that the Fed wants to engender. They're clearly angling to cut. So, saying nothing at all and endorsing in no way this November shift isn't what the Fed wants to do. That isn't how they're going to sustain the status quo. At the same time, if the Fed endorses the rate cut outlook in a full-throated, unambiguous, we're definitely cutting, it's going to happen soon, the pendulum has turned kind of way, well, then the markets might conclude, wow, this is a much more dovish Fed than even we thought over the course of November. And then inflation expectations really might jump up. And the whole thing can become unhinged again. So if you're the Fed, you need to walk this tightrope carefully and try to, with a mix of the updated forecast set and the policy statement and the press conference with Jay Powell after the meeting, to keep as much of a balanced perspective and as much of a neutral perspective to sustain this Goldilocks situation as possible. And so perhaps what you do is you remove the tightening bias from the policy statement. You adjust the forecasts to signal slightly lower inflation and slightly higher unemployment, especially later into the outlook. And then Powell comes out hawkish in the press conference and makes sure markets don't over-extrapolate that kind of nod to oncoming rate cuts to think that things are going to run away in a hurry. If the Fed is successful in doing this, the implications seem to be that having spent November baking in these cuts, the markets are essentially out of a story with 2 weeks left in the year. The main inspiration for what has been occurring through November, as we can see here, is cheaper money in the future. It is decidedly not a better picture for the economy, which we can see has not improved over this period of time. As a matter of fact, we've seen nothing but more deterioration since the middle of the year. The U.S. economy has not gotten better. If anything, it has landed and stalled. So that isn't the reason why stocks are higher here in the past 6 weeks. Cheaper money as a forecast is the reason. And if the Fed manages to keep an even keel on its messaging here because it doesn't want to veer one way or the other, that story has ended without setting up necessarily what is the immediate adjustment to be had right now, without saying, oh, you're too dovish or you're not dovish enough. And what that sets up then is just a round of profit taking on what happened in November. And what was the story in November? Higher stocks by a large margin, almost 9% in the S&P, over 10% in NASDAQ, lower rates across the curve, sharp decline in the 10-year rate, sharp decline in the 2-year rate. And we can see here, looking at the euro here as a proxy for the direction of the dollar, the euro a little bit higher, so the dollar a little bit weaker. Gold a little bit higher, of course, as well, because a weaker dollar and lower yields speak directly to gold's non-yielding anti-fiat character. So if the Fed does little else but succeed in giving the markets a balanced perspective that lets the status quo that they're surely enjoying sustain, you get perhaps a correction across all of these, with perhaps the exception of crude oil, which seems to be dancing to the beat of its own drum. It's been down for the past 7-8 weeks in a row. So the implication then might be, in the immediate aftermath of the FOMC, slightly lower stocks, slightly higher yields, a slightly stronger dollar, as the markets bookend the story and say, right, November was by the rumor. With confirmation with this FOMC announcement, it's time to sell the fact. And that is macro money for today. As ever, we are here Monday through Thursday, right after Overtime, which is a show that I co-host with Chris Vecchio and Dylan Radigan, looking at what happened on Wall Street on a given day and what it might mean going forward. I'm back on with Chris for Futures Power Hour on Fridays, on with Tom and Tony for First Call on Sundays, opining on the platform formerly known as Twitter at Ilya Spivak, and writing for the news and insights portion of tastylive.com, where as of now, the written summary of this very analysis is already sitting. Thanks very much for joining. Good luck out there. We'll be back tomorrow. Take care.